All right, we are live. All right, welcome back, everyone, to the Mr. Rent-to-Own Homes show. My name is Dominic Danino, aka Mr. Rent-to-Own Homes. And in this episode, we're going to be talking about the Fed rates, which is the hot topic of the day, and what is a prepayment penalty, and how it applies to loans and or our rent-to-own homes program. So today, I am joined by James Brown, real estate investor, agent in Colorado. So welcome back, James. It's been a couple of weeks.
Yeah, yeah, we had stuff popping, so good to get back in this. I always have fun doing these.
So things have been active, right? So what's been going on with you? Anything you want to share with the crowds of stuff that's been going on in your world?
Yeah, few rent-to-own opportunities popping. I've got a couple different listings as an agent, so there's more inventory. Buyers, as we're going to talk about,
Yeah,
are getting all excited because the rates are
are
moving
moving.
around. A lot of rumors and stuff. So
Yeah, rates are moving. Activity is starting to pick up a little bit, right? But the key with that is always kind of being out there, connecting, networking, bringing value to not just your clients, but other people in the community, partnering up, right? So collaboration over competition, as we say. So yeah, definitely. So okay, so we're gonna get into the hot topic of the day and what happened yesterday with the Fed's announcement. So, what did you hear? What's the rumor out there from the agent side? What are you seeing from people out there?
heard there was a drop. The Fed and the mortgage rates don't necessarily go in lockstep, right? And I don't really understand exactly how that works. And sometimes there's delays, right? So maybe you can jump in and explain that because you're the lender and really understand that well.
Yeah, so that's a great topic, and there's a misconception that the Fed sort of controls rates, and so everything that falls under rates, they think, okay, well that includes mortgages, right? So what the Fed controls is what's called the Fed funds rate, meaning what banks lend can the rate banks lend to each other overnight to hold deposits, right? So if you understand banking, the regulations say, hey, me as a bank, I have to hold so much capital at the end of the day, or mark to market as they call it. Meaning, if I have so many loans and have so many assets, how much in liquidity do I have to carry? So typically it's about 10%, right? So, but if I'm short at the end of the day, what am I going to do? Am I going to call clients, that have checking accounts? Hey, can you bring in some additional cash because we need more money in the bank, right? No, that's not happening, right? So what they do is they call another bank that has excess funds so that they can meet their minimum requirement. Say, hey, I need a few $1 billion because I'm short. Okay, so let's say Chase calls B of A. B of A say, yeah, I got a couple of $1 million, but the overnight rate or the rate that I'm going to charge you for that is what the Fed sets the standard for that,
Mm.
right? So then they give them the money, right? And then the interest for that particular day is calculated on that. So Chase pays B of A so that way they can meet their closing day requirements, right? Make sense? So they may be short. So that's what the Fed sets up, right? So that way, no Chase says or B of A does say, well, too bad, Chase. I'm gonna jack up the rate. I'm gonna charge you 50% because I'm hoping that you go out of business because you're my competition, right? Obviously, we couldn't have that because you have systemic risk of that, right? If one goes down, right? So banks are intertwined. So, anyways, so that's the Fed funds rate. Now, what predicts rates or what impacts interest rates or mortgage rates is called the 10-year treasury. So the 10-year treasury is a treasury note that the government, when we borrow money, right? So we borrow money for our deficit, and we borrow money, or the U.S. government borrows from the Fed, right? So the Fed creates notes or bonds, basically, right? They're instruments that they pay interest on. So I can buy, or institutions can buy, or countries can buy those bonds at a certain interest rate that the Fed is offering those bonds at, right? So that's called a 10-year. One of those is called a 10-year treasury. There's a 2-year, a 5-year, a 30-year, and so forth, right? So a 10-year treasury. So if I am a investor and I can get 4% interest on a $100,000 bond or a treasury from the government that's backed by the U.S. government, that's never defaulted, right? That's as secure as it can get, right?
Yeah.
I'm going to be pretty sure that I'm going to get my 100,000 back, and I'm going to collect interest over 10 years, or 4% annualized over 10 years, right? So that's as secure. Well, if I have that money and say, can I get a higher rate of return for my $100,000 instead of doing that? Well, anything that's higher risk than the government backing that money should pay a higher rate of return because there's more risk. Make sense?
Yep.
So what could be the next thing that is still safe, but not as safe as the government? How about a mortgage note?
Yeah.
Right? Well, if I can get 4%, 100% guaranteed by the government, or I can get 5%, 6%, 7%, whatever that may be, to do a mortgage, right? Because mortgages are amortized over 30 years or 10 years or whatever. So a mortgage-backed security, right? Then I should collect a premium over the Fed's rate, right? Because of the higher risk. So when mortgages are done, is, hey, as a mortgage company or as lenders, the investors that put up the money are going to charge a spread between what they can get from a 100% guaranteed 10-year treasury from the government to what they would charge, right? So there's a spread. Make sense?
Mm-hmm.
A premium to do a mortgage instead of a treasury, right? So that's what fluctuates in the market as demand or supply changes, right? And so as the 10-year treasury fluctuates up and down, that spread could stay constant, or it could widen, or it could shrink, right? And so let's say in that 4% example, if that spread currently is about 2%, then you take the spread plus the index or the treasury at 4%, then that's what typically mortgage rates are at, right? So the 10-year treasury is a better indicator of, as you follow that tells you where rates are. So follow the 10-year treasury. You want to know what conforming rates are. So when I say conforming, I mean like conventional FHA, VA, right? Those what they're based off.
Yeah.
They use that as the indicator, right? So if the interest rate on the 10-year increases, then that margin pushes up the total rate, and vice versa.
Yeah.
Right. So that's one. So typically that spread historically has been at roughly 1.7 or so. Right. So typically the 10-year treasury was at 4%. Based on that historical average, then mortgage rate should be at 5.7.
Yeah.
Make sense?
Yep.
But that spread can widen too. Why can it widen? Because the market is unstable, or rates or things are moving, right? So there's a risk premium that widens that margin. And we've had that for those of you that have been in the industry. Let's see. And when the Fed started raising rates, March of 2022, and then later as 2022 came along, they were raising rates pretty quick. They were raising 0.75% each time. So what happened is Some lenders went out of business. If you heard, there were some lenders that went out of business because they couldn't keep up with and here's how typically that works, right? Lenders don't have all the money, right? They front the money to close on a loan, and then they take those loan packages, so multiple loans. Let's say a bulk of package of loans of say $10 million. Let's say their agreement is you got to deliver $10 million and we'll buy every 10 million. Well, if you're doing business and you're doing onesies, twosies, threesies at 300, 500, you got to accumulate enough loans to get to 10 million so you can deliver them as a package, because they don't take them ones, right? They don't do single loan buys. They buy it in bulk, right? But if you've been closing loans at 4% before you got to your 10 million, before you can deliver, and by the time you go deliver, the rates went up to 5, 5.5, 6, right? Do you think that this buyer here is going to pay you the same amount? Because though they're buying loans that are paying 4%, if the market is at 5, why would they give you dollar for dollar on that? They don't. They discount it. They'll give you 97 cents on the dollar, 98 cents on the dollar. Make sense?
Yeah.
So if they're giving you just a portion of that, then what happens? Well, who's out of pocket that money? The lender.
Yeah.
Right? So that's what happens. That's what makes these lenders go out of business, because they're not delivering fast enough or adjusting fast enough, or they did not hedge, right? So a way that lenders, so if you ever see the movie Trading Places, right?
A long time ago.
Yeah, a long time ago, right? So I'm dating myself, right? So you had Eddie Murphy and Dan Aykroyd, and who was the other guy?
Nick Nolte?
No, it wasn't Nick Nolte, but Kathy, what is it? Jamie Lee Curtis.
Crap, I don't
Jamie
remember.
Lee Curtis. All right.
Anyway, what's the premise of the movie?
So they're at the Chicago Board of Trade, right? And it's like they're on the pitch, and you're talking, hey, they're selling concentrated orange juice and soybean contracts and pork and whatever, right? Gold and everything, right? That's where that's traded. Well, treasuries are sort of traded that way. I think they're electronic now. I don't think they're open, what they call open pit outcry, the way that it was done back in the day, right? But anyways, those bonds are traded and they're fluctuating, right? So if they can't deliver that at what the market is, so what lenders will do, they will hedge, basically buy insurance to guarantee themselves that, hey, I can deliver $10 million at this rate, right? They're buying insurance, right? It's a catastrophe insurance, basically, right? So yeah, I'll pay $5,000 for the insurance to lock in the 4, because if I don't and this runs away from me, that's going to be a bigger, right? That's why we buy insurance, right? We think about it. Most people will never have to collect on an insurance policy because their house isn't going to burn down for their lifetime. But how many premiums did you pay over 30 years? A lot. But it's catastrophe insurance, because when the time that it does happen, you don't want to be without insurance, because that cost is too much for you to bear on a single time. It's easier to spread out that risk over 30 years, right? So that's called hedging, or basically buying insurance so that you don't get caught with your pants down but see, a lender has to take action and do that. If they're not experienced or they haven't been through a cycle before, they may not realize that, this can run away from me pretty quick because I can't get enough loans locked in to deliver them fast enough at that rate. So then they end up taking the hit, and that's how they go out of business, right? Because they came into a business with, let's say, $100,000 worth of collateral to hedge against that. But if they can't get the money back to do more loans, then it eats into that basically reserve, and then eventually it's done, right? And now they're out of business. Now they got to go raise new capital to create a new reserve, or have somebody else bail them out and say, okay, we'll buy it. We'll recapitalize you. We'll restart the reserve again. And now you can go back doing business, or you become part of us now, right? That's how companies get bought out because somebody with bigger pockets comes in and saves their butt because they got caught in a situation like that. Makes sense?
Interesting. Yeah.
So that's the lending world, right? So anyways, so that's what happened, and because the rates were moving too fast for them to either deliver loans fast enough to meet their requirements, or they did not have a way to protect themselves, a hedge or an insurance, so that they could deliver it, right? So that's what happened during that period of time. And it sort of works the other way too, in a sense. So as rates start to decrease, right, the value of that bond. So there's an inverse correlation between the rate and the value of a bond. So either you can get dollar for dollar, or you can get at a discount, or you can get it at a premium. So let's use that same example. So we use the case where like rates were or the treasury interest goes up. That means the value of the bond goes down, and vice versa. As rates go down, or as the value of the bond goes up, the interest rate or the return goes down. Why does that happen? Right? So during times of war or panic or any major event that happens in the world, you'll hear on Wall Street and say bonds are up, bonds are down, or they're risk on, risk off, or deleveraging. Right? What happens is when you see a big down day in stocks, what happens is that money has to be deployed somewhere. It has to continuously generate returns, right? So what do when they sell stocks? Well, they don't just put that money back into a savings account that's getting 0% or 1% or 2%. What they do is they buy treasuries. They move it from stocks to treasuries, right? Because that's the safe haven, right? Because I'm always going to have the government back it. The U.S. government is never defaulted, so I know at least I'm going to get my money back, right? So risk off, when they say risk off, so stocks are riskier. So when it's risk off, then they buy bonds. Well, if there's more buyer of bonds, let's say there's 10 buyers of this one bond, doesn't the value of the bond increase, right? Because there's more demand for that same amount of bond, right? So instead of me giving you a bond at 100 at 4%, well, these people are willing to pay 101, 102, 103, 104, right? So 105. So they're paying $105,000 for a $100,000 bond that returns 4%. Well, if you do the math, the yield, right? If I'm spending 105, I'm not getting 4%, right? It's an inverse correlation, the return, meaning I'm getting less than 4 because I'm having to pay a higher price for that $100,000 bond. And on the reverse side, when they're selling off, if there's a bunch of people that are selling their bonds, they're not going to get 100. They're going to get 99.5, 9.99. So it's like me saying, hey, James, here, you got a $100 bill, but I'm going to give you $99 for that $100 bill, or $98 for a $100 bill, $97. Well, who's making out? Right? I'm getting a higher return. I'm buying $100, but you need change. Let's say you need ones. You're at the club or whatever, and you need ones.
Yeah.
Right? And he's like, I only got a $100 bill. It's like, sorry, I got 97 ones for you. You want them? Sure. Okay, I'll take it. Right? And on the reverse side, I got too many ones, and I got a bunch of pocket full of ones. Like, hey, I need to get larger bills. And you say, well, I'll give you this 100, but you got to give me $101. 102 of those single dollars, 103, right? You're winning, right? So there's a reverse return. So that's kind of how it acts. So that is the Fed, and that's how rates are impacted, and then how you can gauge as to what's happening with rates, mortgage rates anyways, right? So mortgage rates, you want to use the 10-year treasury to see. And then if you look at the 10-year treasury and you compare it to like conventional mortgage rates, where's that premium? Where's that spread now? And then it could change. the spread during that time period during 2022 widened all the way up to 3%. That's why rates jump up so high fast, right?
Mm-hmm.
Why? Because somebody's not willing to buy those rates, right? Because as rates are going up, let's say rates are going up, let's say, hey, why would I want to buy a 5% note when I know in 30 days or 45 days or 60 days or 90 days, the rate is going to be 5.5? Why would I want to take 5% interest now? Right? So some people will say, you know what? I will do that. But on the other end, so I'm borrowing and I'm lending, I want to create a bigger spread because I don't want this rate to go above what I've lent for, right? Otherwise, I'm in the hole. It doesn't make business sense, right? So that's why the spread can widen during wild cycles or fast moving cycles.
Mm-hmm.
So that's how rates act or why they act that way. And then the impacts of the Fed, it's usually what happens is the bond traders are already anticipating what the Fed is going to do, right? So it's not like, okay, we're waiting today. They're going to lower it. And then they're waiting, okay, yeah, went down 5. Okay, now we're lowering the interest rates 5% or half of 1%. They're not doing it. Right, that's why they always talk about the Fed notes and when Powell has his conference or his conference call or whatever it may be, right? He stands on a podium, starts talking about it. People ask him questions. So traders are trying to anticipate the next move, right? They're not waiting for the move to happen before they act. They're trying to anticipate it and get ahead. Right?
Mm-hmm.
If you wait for the move, then it's too late. Right? So that's why when the Fed said, yeah, because last meeting they announced and said, yeah, we're probably going to lower rates in September. So during that time, conventional rates were at 6.5, and they've started to trickle slowly, right? So because some people are getting ahead of that move. So by the time the move is or the announcement comes, the move has already taken place. Now, the next leg, now they said, yep, so people were anticipating already half. So that's why rates went from 6.5, 6.6 down into the 6.1. So that move has already taken place. But also the Fed said, hey, we're going to do another half before the end of the year. So what we'll potentially see is it'll just dribble down, right, from 6.1 down to a little bit around 6. And at a certain point, right, it'll dribble down into the announcement, right, and may not go all the way to 5.5 as people think. It may, it may get down to 5.7, 5.6 or so forth, right? And then that meeting they say, oh, over in 2025 we're gonna do another 200 basis points. Now the market will continue anticipating, right, and it'll just start to. So the move doesn't happen when they announce it. They anticipate that move. So
Mm-hmm.
the move of the half has already taken place, basically, right? So if I look at my handy dandy mortgage news daily, where you can see what the average rates nationally are, right? So we're at 6.17 on conventional 30-year fixed. So anyway, so as you can see, it bottomed there, right? We got to 6.11, I think, 2 days ago. So the day before the announcement, we got to 6.11. Now we're at 6.17, right? So there's been a little bit of a bounce because of the anticipation of the move already. However, we're talking about the activity, right? So we're all over social media, and I see on social media everybody talking about, right, agents and lenders. Hey, the Fed lower rates. Let's hop back in. Or hey, if you were pre-qualified 30 or 60 or 90 days ago, and you could only qualify for 400 because the rate was at 6.5 or 6.75, that you may potentially qualify for more now because your payment, right, the equivalent payment at a lower rate should buy you more house. So now you don't qualify for 400, maybe you qualify for 420, 425. Come back, call me. Let's look at it again and see if you can qualify, because maybe the house you think or you thought you were trying to get, you couldn't qualify for that, but potentially you could now, right? So that's something to look out for. And so that's going to generate some activity. And then also typically the general public is sort of late to the party, right? Because us who are in the industry are kind of, we sort of stay on top of this stuff. But the general population has got a regular 9 to 5 that they're going to work. They're not paying attention to rates in general, right? They're not paying attention to the risk. You know, they either have a house that they live in, it's like, yeah, whatever. Or somebody that's renting is like, yeah, okay, if I get the opportunity, or if they're actively looking, sure. But generally, it's not so. What you'll see is people will hear it in the news, right? So I was telling my my brother and sister, I was like, once it gets out into the regular news where the average person is seeing, this is when you start hearing more activity from potential buyers and people asking the question, hey, I just heard the rates came down 0.5%. So what is it? What is it now, right? So I mean, that's the general population, but the move has already taken place. But it'll create some activity and people reconsidering, right, where they've kind of been paralyzed, basically, right? So
Yeah.
So any tidbits you want to share with that as it relates to what you're seeing, activity, how does it impact you? And then I know you have a couple of potential or properties that you got on the market now, right? So, yeah.
Yeah. I don't know that I've got much to add. Just buyers are on the fence. And it's first-time home buyers typically that can barely afford anything that are really affected by this, you know, because they might not be able to afford a home in a safe area where they near the school they want to be in. Rates when they're high, they might have to be in a tougher neighborhood or not be able to buy as big of a house and have to be sharing bedrooms, that kind of thing. So
or let's say for one particular property, the payment would have been $3,000, but not because let's say 0.5%. Now that payment, say it's $2,800 or $2,750. It's like, okay, now I can do that. I can't do the 3, right? So it could have an impact on the potential house or how much more they qualify. It's like, oh, well, I could do the 3, but that was only buying me a $500,000 house. But now I can do 525 because now it's a nicer house or a bigger house, extra square footage, or it's got a pool already, or wherever it is, right? So you're buying up a little bit. So for the same payment, because of the way that rates impact payment, right? Because Americans, we're payment buyers, basically, right? The general public is payment buyers. Like, can I afford the payment? And if I can't, great, I can do it. If I can't afford the payment, then I can't do it.
Yep.
So, now, the thing with that, though, is if we get continuous trickle down of rates and activity picks up, now you potentially could have, remember that 420 or that 525 house that only had one buyer. Now somebody that was at the 500,000 range, the rates went up. Now they're a second buyer at that 525 and maybe a third. Now you potentially could have more buyers for that same house, and now you start getting into the bidding wars, right? That's how the bidding wars start.
Teeter-totter. Rates go down, competition and price goes up.
Yeah. Right.
Mm-hmm.
So, and then that also impacts prices, right? Because that same payment buys more house and vice versa. It's like, oh, well, now I have 5 buyers for this house when I only had 1. Well, it ain't 525 anymore buyers. It's 535, 540. Who could do 545? Who can do 550, right? And now you start getting the push up on the price because there's higher demand, more buyers at that price point.
Yeah. I mean, I was mainly just doing listings in 2020, 21 when it was insane like that. I felt really bad for those buyers that were having to bid, and then some of them had to turn around and sell, and they overpaid for those homes, you know. They had no equity. If they had to pay out the commissions on both sides, they were underwater, you know.
Yeah, so they bought at the top, basically, right?
Mm-hmm.
And unfortunately, right, I mean, home ownership really shouldn't be a speculation kind of play, right? It should be, hey, this is where I want to live, the right school district, the right location, close enough to my job, whatever it may be, right?
Yeah.
And so home ownership should really have at least a 5-year outlook.
Yeah,
right?
totally.
Does stuff happen before that? Of course. Yeah, life events happen, but generally you should have at least a 5-year outlook. So that way you don't run into those issues. And there is a problem in general with the perception that, hey, I want to put the minimum. What is the minimum? How much can I get into? What's right? But it doesn't help you when you got to exit, right? Because if you put the minimum and you got to exit, there are costs associated with that exit. And then there's no buffer built in to let you get out of that. So that's where being in the hole is, or having to come out of pocket to pay for the fees and or an agent, because an agent isn't going to want to work for free. They're going to say, yeah, I'll put it in listing and make no money, right? So it's either comes out of the net sale, or you're going to have to come out of pocket for my commission, Mr. Seller, because there's not enough equity or we're not getting enough price. So what ends up happening, they're either stuck or have to come out of pocket, or we have some creative methods to potentially buy those properties that don't have any equity, right? And that's a different conversation we can have. Somebody's interested, hey, if you got a seller that doesn't have equity and can't pay a commission, potentially we could be an option for you where we could potentially buy that property, right? So that's another discussion, right? That's a sub-2 or a creative method of being able to buy a property for a period of time until the market changes, and then be able to sell it and allow the person that needs to move to get out from under that or move on, right? So because if they got to go, they got to go, right? If you get a job relocated or something is happening, or I know it happens a lot with on the veteran side, right? That you get relocated, you're at a duty station for a year or two, and then you got to go, but you just bought a house, and VA lets you do 100% financing. So if the market was flat and you financed 100%, and now you got to go 2 years down the road, well, how are you going to sell it, pay for the cost, and pay an agent? There's no equity. So you would have to come out of pocket. Well, I mean, if you financed 100%, that means generally you didn't have any money to begin with, right? So now what happens? And they got to go, right? It ain't like they can ask us, hey, can I stay an extra year because I can't sell my house? No, right? You got to go. So something has, and if you got to go, now you're carrying this payment and you got to go find housing somewhere else. I mean, I guess you could live on the barracks for free, but generally people don't want to do that, right? So, but I got to find a new place, either rent or maybe I want to buy another house. Like, well, yeah, you can't even get rid of this one first, right? So there are options. There's creative ways for us to help people in that situation, right? Those are one-on-one conversations we can have off topic. I don't want to dive into this, but you and I both knows those methods. So that's why it's important for people to work with people that have been around a little bit, have the gray hairs, have been through some of the cycles, understand some of these things, dynamics of the market, multiple exit strategies, creative ways to kind of provide a solution, right? For a solution. So, we like to think of ourselves as, problem solvers, and that's kind of where we come in. So anything you want to add to that? I know you've done a few of those and you understand that method, right? So yeah, can you want to talk about that?
Well, I did want to point out, like, those same principles and apply to whether you're buying a home the traditional way through a bank or through rent to own. The more money you put down, the more you've got into the deal. And also, this should be long-term. Like you said, 5 years minimum. Like, rent to own and buying a house through a bank is not a short-term solution.
Yeah, we want to work with people that have home ownership in mind, right? It's not, I tell people during my presentation, this isn't for speculation. This is, hey, I'm going to get into this house and it's going to go up 25% and I'm just going to flip it in 12 months and make money and go do it again and whatnot, right? This is for home ownership. You got to want the house. You like the area. you got to have at least a 5-year to 7-year outlook, right? Because that's going to withstand the cycles, right? Typically, most housing cycles are 7 to 10 years. So at least you got to give yourself some period of time, right? And, yes, life happens, but generally you want to come in with that outlook and say, hey, this is where we want to be as a family or as an individual. And, because this is home ownership, right? It's not, I mean, if you're going to be bouncing around, then you should just go be a renter. You really should be a renter, because it doesn't help you, because there are costs associated with acquiring and selling. So avoid those costs if you have a short-term outlook.
It's not try before you buy.
Yeah.
A lot of people come into it thinking that, oh yeah, I'll just rent, and that's not the right attitude and way to go about it.
Yeah. That's why we call it rent-to-own-homes as an alternative path to home ownership, right? But it's still home ownership, right? You act like an owner, you're a homeowner, and your intent is to be a homeowner, and we can help you based on your situation, right? If you don't qualify for traditional financing. So, and any final thoughts? I know we've had a few situations. We were just talking about, another client that, their situation changed, but we can't predict that. They couldn't predict it, otherwise they would have never done it, right?
Right.
We can't predict divorce, right? We can't predict car accidents or somebody getting ill down the road, right? That's stuff that's beyond our control, and even if you got a traditional loan, the bank isn't, you're gonna say the bank and say, hey, well, I got divorced, so can you take the house back? Can you give me my money back? Or, right? Like, no, the bank is saying, we want your payments. I don't care what it is, right? If you want to give the house back, then it's going to be a foreclosure on your credit. Yeah, we'll take it back and resell it, but you're not getting this money back, the down payment back that you gave them, right? Right? So yeah. So that's, but we're here to help you get there, but you got to do your part too, right? Okay. Then last but definitely not least, right? So this is kind of leading into that. Like, so one of the questions that I get asked is like, is there a prepayment penalty for a rent-to-own-homes program? So if somebody gets into a house, they're working on their credit, they're working on their taxes, they're working on whatever that they got to fix up because they couldn't qualify for traditional finances. So it may take them 12 months, may take them 18 months, 24, 36. Could even take them up to 5 years for all that matters, right? So they're working towards fixing it up. But somebody says, well, is there a prepayment penalty to once I get, let's say I win the Powerball, can I pay you off, or can I just buy it out? Yeah, by all means, you can buy us out. There is no prepayment penalty, right? There is no penalty as it relates to that. So yeah, if you hit the lottery, by all means, pay us off. You go your way and we'll go our way, right? And we'll shake hands and say thank you very much. Nice doing business with you. I'm glad we were able to help, and maybe you could buy us lunch or a coffee with that Powerball winnings or something, right? Or invite us to the pool party or wherever whatever you're gonna celebrate, invite us, right? So we'll happily go to that. But if that's the case, then yeah, by all means. So you're not. If you come into the means to be able to just buy us out, you're more than welcome to do that, right? And we don't push people from the standpoint, so you can go as fast as you need to go, but we basically outline or set our program up based on what you need, based on what we can tell today, right? But if you're able to move faster or get those issues resolved faster, then by all means, it'll speed up the process for you, right? Yeah. So we'll be happy to help you along the way. If that's the case, right? So, and we're very clear with people and say, hey, yeah, we're giving you up to this amount of time to go ahead and fix this up. We're giving you even extra time, more than you would need. Go do it. Well, if you need us to point you in the right direction, the right individuals that can help you along the way, we're not going to do it for you. We'll give you the tools, but you got to go execute and go do it yourself because you're a grown-up, right? We work with grown-ups that have ownership in mind. We're not babysitters. So yeah, go do it. And if you do your part, we'll do ours, right? And if you need help along the way, by all means, we're here. We have the resources to help you also. We'll give them to you initially. And then if something comes along the way, you need a plan B, plan C, let's talk about it. And if you can get it done faster, hey, great, let's go, right?
Yeah.
So prepayment penalties. So we don't have a prepayment penalty for our rent-to-own, but prepayment penalties generally, what it means is, hey, somebody has a minimum time period where they have a loan. Now it could be a home loan, it could be a car loan, it could be a personal loan for whatever reason, right? Generally, car loans don't have a prepayment penalty. Anything consumer related doesn't have a prepayment penalty. Generally, more business related, business purpose loans will have DSCR loans will have a prepayment penalty. So non-consumer loans will have a prepayment penalty, but prepayment penalties generally are saying, hey, you got to make payments for at least a minimum period of time. And then after that time has passed, then you can just give me the rest, right? But I have to collect interest for at least a minimum period of time to make it worth my while, right? Because lenders aren't in the business of just giving you money, going through all the paperwork, because that costs money, setting it up on a system where you can pay it online and send you a book coupon and all this stuff. That costs money. They cost employees to set it all up. And then on day 3, say, oh, here's the money, right? So lenders don't make money that way. Lenders make money collecting interest and payments over time. So they may have a prepayment penalty and say, I got to collect interest for at least 6 months, 12 months, 24 months, whatever that may be, right? And sometimes they may give you a discount and say, hey, if you do a longer prepayment penalty, the interest rate that I give you, I'm going to give you a better interest rate.
Yeah.
Like, okay, you can decide based on your situation whether you want to do that or not, or it's necessary, right? Or say, hey, shorter period loans, the interest rate is going to go up, right? Because I got to collect interest, right? So I make money as lenders make money on interest. So if I only have to collect 1 month, 2 months, 3 months, then the interest rate is going to be higher, right? Because I got to make up for the time period that I'm not collecting interest. But if you go longer, okay, I'll give you a lower rate. So I'm collecting less interest, but I'm collecting it over a longer period of time, right? So some lenders will have a prepayment penalty and say, hey, if you pay me off before 6 months, 12 months, whatever that may be, there is a premium, say 6 months worth of interest at the minimum, right? Because I went through all this trouble to give you a loan, and I didn't get a chance to at least collect 6 months worth of interest. So that's the deal. You want the loan? Yes. Okay. Because you're anticipating not to pay me off, right? Because otherwise it'd be a problem. You can still pay me off. That's okay. I'll take the money, but I'm going to charge you a penalty for that. And some people could choose to say, you know what? I don't care. I won the Powerball. What's 6 months worth of interest, right? It's not a whole lot, right? When I just collected, I don't know, 150 million or whatever it may be. So I don't care. I'm out, right? And the lender say, okay, not a problem. Just give me the 6 months prepayment interest, and they go about their business, right? Or whatever that may. You hit the Powerball, inheritance, whatever it may be. So that is, in essence, a prepayment penalty. So you should know that up front. And most people ask, but generally on consumer loans, there isn't anymore, unlike in the past. Consumer loans, because of the new regulations post financial crisis in 2008, Dodd-Frank, and the inception of the CFPB, Consumer Protection Agency, Consumer Finance Protection Agency, right? Or Bureau, I'm sorry, CFPB, Consumer Finance Protection Bureau. So those rules have come into effect, so people don't feel like they've been taken advantage of, right? But that's why generally anything consumer related doesn't have that. We don't have it. You may encounter, though, if you do business purpose loans for short-term rentals, long-term rentals, fix and flip, commercial investment properties, right? Anything that's non-consumer, something that you're not going to occupy. It's considered an investment or business purpose, and those you may encounter those. So, anything you want to add to that?
Nope. Just I just want to point out that we are talking rent to own, no prepayment penalty.
That's right. No prepayment penalties. So hopefully you do hit the Powerball and you invite us to the celebration because we were nice enough to get you into a house when you couldn't, right?
Yep.
So, all right. Any final thoughts on our discussion? The Fed rates and prepayment penalties.
No, that was a lot of great info. I learned something. Hopefully everybody else watching this show did too.
Yeah, absolutely. And if you have one of those situations, whether you don't qualify for traditional financing or you're an agent or lender, you have clients, or if you have clients that are underwater or don't have enough equity to pay a commission or closing costs, potentially there's potentially creative ways for us to be able to help you and still maybe pay you a commission out of that, right? Because you brought us a deal and it has to be the right individual and situation and so forth. But we can have those discussions. So somebody wants to get a hold of you, James, and kind of has one of those situations. How can they get a hold of you?
Yeah, go to, if you're watching the video, Linktree/partner with James Brown. And I got all sorts of ways to connect with me there.
All right. And if you want to get a hold of me, you can go to our website. That's rent2ownhomes.com. That's for our Rent to Own Homes program. We have a explainer video halfway on the homepage. You can watch the video explaining how our program works. You can enter your information if you want us to contact you. We can go over your situation and how we maybe will put something together. Or if you want to get a hold of me on all the socials, I'm at MisterRentToOwnHomes on Instagram, TikTok, and on YouTube. And in my bio of this video, you can also see my email address, phone number, and you can find me on Facebook. I'm Dominic Danino on Facebook. All right. Until next time, see you then. Take care. Bye-bye.